You can't legally outright avoid your tax liability, but there are simple steps you can take today to help reduce your tax bill. Before we jump in, it's really important to note that tax rules are constantly changing. We do our best to keep up to date with the latest guidance. This video is general information only and is not tax advice. So please speak to a qualified professional if you're looking for tax advice. Hello, my name is Nelly and welcome back to another video. First and foremost, if you enjoyed this video, if you enjoy this concept, let me know by dropping a like and leaving a comment. And if enough people do that, I will make a part 2 with 5 more ways to pay less crypto taxes. So take a moment to do that. Okay, so let's jump into the video. You can't legally outright avoid your tax liability, but there are simple steps you can take today to help reduce your tax bill ahead of the end of the financial year. So some of these things that we're going to talk about today are track your gains and losses, harvest your unrealized losses, offset your losses against your gains, hodl, and then pick the best cost basis method. If you're looking to specifically learn how crypto is taxed in the US, I've made a video on that, so I will leave it in the top right corner of this video and in the description. Okay, let's talk about number 1, track your gains and losses. If you've had a great year when it comes to gains, there is a tax bill coming your way, yet many investors don't track their gains or losses throughout the financial year to keep on top of their tax liability. Using a tax calculator and portfolio tracker like Coinly, this will be very easy for you. Once you've set it up, you'll be able to see a complete overview of your realized gains and losses, all from the comfort of your dashboard. So you'll always know what your tax liability is from your crypto investments. As well as this, you can keep track of your losses on a macro and micro level, which is important as you can use these strategically to reduce your tax bill. Okay, number 2, harvest unrealized losses. So there are 2 different kinds of losses. One is realized losses and the other is unrealized. So a realized loss is a loss you've made as you've disposed of an asset by selling, swapping, or spending it for a lower price than you acquired it for. Meanwhile, a unrealized loss is an asset that is decreased in value since you've acquired it, but you haven't realized that loss as you still hold on to that asset. So to give you an example, if you bought a Bitcoin for $20,000 and now it's valued at $16,000, but you're still holding it, that is a unrealized loss. You'll only realize your loss if you sell, swap, or spend your BTC. So you might be wondering, why does this matter? Well, all of this matters because these losses can help you reduce your tax bill. If you do realize them, once realized, you can offset your losses against your gains and pay less overall tax. There's no simple answer to when you should realize a loss. It all depends on your personal circumstances. But in the current market, your unrealized losses are likely raking up. In these situations, it can often be more beneficial to you to sell your NFT at a loss and use that loss to reduce your tax bill. Similarly, for coins with no value, whether that's due to a rug pull or a crash like Luna, you may be better off realizing these losses by selling, swapping, or sending them to a burn wallet if the former options are not available to you. Okay, moving on into the next one, we're talking about offset gains and losses. So as with any investment, you can take advantage of crypto gains by also claiming losses on other investments the year you realize your profit. So that means if you've made, let's say, $30,000 from selling Bitcoin, but you've lost $30,000 from selling Ethereum, you wouldn't owe any tax since you've broken even. If you are about to cash in a large crypto investment, look through the rest of your portfolio to see if there are any other losing investments you could sell to offset your gain. In even better news, if your capital losses exceed your capital gains, the amount of the excess loss that you can claim to lower your income is lesser than $3,000, or your total net loss shown in line 21 of your Schedule D. So if your net capital loss is more than this limit, you can carry the loss forward into later years. So that's really awesome and really beneficial. If you consciously use this to your advantage, this is called tax loss harvesting. And we're actually working on a longer video just specifically about this topic, so make sure to follow the channel and stay tuned for more. Okay, let's move on to the next one. Hold on. The easiest way to pay less tax, you simply hodl for a long time. There are actually 2 different IRS capital gains tax rates, one for short-term gains and another for long-term gains. So short-term gains tax rates apply to any assets you've held for less than 1 year. Your short-term capital gains tax rate is the same as your normal income tax rate. Of course, for some investors, this can be quite steep if you're in a high income tax bracket. Long-term gains, on the other hand, are taxed at a much lower rate. Any asset you've held for more than 1 year is going to be a long-term capital gain. You'll pay between 0 and 20% in tax on long-term capital gains on crypto, while long-term gains from NFTs deemed collectibles may be taxed at up to 28%. If you want to find out more information about these rates specifically, I will leave a guide down below, and I will be working on a video as well in the near future. So when that's ready, I will also leave that down below. And lastly, let's talk about picking the best cost basis method. So actually, the IRS lets taxpayers choose their cost basis method. This is the method you use to calculate how much your assets cost you and which you sold and when. This might sound like a big deal, but the cost basis method you choose can make a huge difference on how much tax you'll pay. According to the IRS, US taxpayers can make use of the Spec ID cost basis method, which means you'll specifically identify each unit sold. Thanks to its flexibility, Spec ID can accommodate other cost basis methods, including FIFO, LIFO, and HIFO. There is no best cost basis method per se. It will really depend on your crypto assets and transactions. You can only choose one cost basis method to use for the year, and you'll need to stick with it. So it's worth taking some time to figure out which one really works best for you. And we do have a feature on Coinly where you can alternate between the cost basis methods to better see which one is best for you. And there you have it, 5 ways to pay less crypto taxes. If you enjoyed this video, consider dropping a like, leave a comment down below, let me know how much you enjoyed it, and I'll gladly make a part 2, and I'll see you in the next one. Peace.